As I record this, Bitcoin is down over 14% year to date. Ethereum is down 30%. Your portfolio is bleeding, X is full of people swearing they're finished with this space, and the altcoin season index is sitting at 37 out of 100 when you need 75 to even call it a season. But underneath that boredom, Hyperliquid is up over 130% year to date, Zcash is up 50% in the last 30 days alone, and Bitcoin exchange reserves just hit a 7-year low. So, in the next few minutes, I'll walk you through exactly why the 2021 playbook is dead, look at the 2 specific case studies that smart money is pricing in right now, and lay out the framework you should actually be using during this lull. My name is Guy, and you're watching The Coin Bureau. Now, on the off chance that you're still running the 2021 playbook, then you're going to spend the next 18 months wondering why nothing is working. Put simply, in 2021, every rotation lifted everything. You bought 47 random bags by throwing darts at CoinGecko, and the rising tide of retail liquidity carried you to massive gains. That mechanism is gone, and it ain't coming back. And the reason is that the capital structure of crypto in 2026 has fundamentally rewired itself around 3 forces that did not exist in any meaningful way in 2021. The first is ETF concentration. Cumulative spot Bitcoin ETF inflows now sit at roughly $58 billion, with approximately $99 to $102 billion in assets under management. And those ETFs collectively hold approximately 7% of total BTC supply. Every dollar going into IBIT is a dollar that's not going to find its way into the long tail of altcoins. The second is VC unlock overhang. Approximately $97 billion in tokens were released through vesting schedules in 2025 alone, with weekly unlock events frequently clearing $650 to $770 million in fresh supply hitting the market. And the third is supply oversaturation. Over 11.6 million tokens failed outright in 2025, and active wallets on Pumped Up Fund collapsed from 5.2 million in May 2025 to just 1.8 million by December. The meme casino is closing. Meanwhile, Bitcoin dominance is currently holding around 59%, with that figure climbing significantly over the past several months. To put that into context, at the peak of the 2021 altcoin rotation, BTC dominance fell to roughly 40%. So that spread, that 20-point gap, is the principal reason why altcoin breadth has collapsed. 18 out of the 20 tokens in the CoinDesk 20 index are posting losses. The ETH-BTC ratio is down nearly 20% year to date. And Ethereum itself, the largest altcoin out there, is down over 30% year to date, when historically ETH has been the asset that leads alt rotations. So the rising tide model is broken because, well, the tide is not rising for the long tail anymore. It's instead rising for a very specific and very narrow set of assets that have something the 2021 alts never really needed: actual revenue. The filter for what actually catches a bid has completely changed. So, let's talk about what the filter looks like in practice, because there are 2 assets in this market right now that are passing it with flying colours. The first is Hyperliquid. Hype recently set a new high above $64 and with a market cap of around $13 billion. But the real story here isn't the price action, it's the underlying cash flow. Hyperliquid generated approximately $11 million in protocol fees in a single week in May 2026. That's roughly 43% of all blockchain fee revenue generated across the entire crypto market in that window. In all of 2025, Hyperliquid cleared $2.6 trillion in notional trading volume, which is more than Coinbase did in the same period. Its open interest is now roughly 92% of Coinbase's entire perpetuals book. And most importantly, 97 cents of every dollar in fees goes directly into an automated block-by-block buyback of Hype from the open market. And rather than relying on a discretionary team promise, this buyback is hard-coded at the protocol level through what Hyperliquid calls the assistance fund. It cannot be paused or modified by a multisig. It scales mechanically with trading volume. And to date, that mechanism has deployed over $1.2 billion in cumulative revenue into open market Hype purchases. Matt Hogan, the chief investment officer at Bitwise, has called Hype one of the most mispriced assets in crypto, arguing the market is incorrectly valuing it as a leverage platform rather than a real competitor to CME or Robinhood. Now, before we go further, if you want to stay on top of the biggest stories in crypto every week, then the Coin Bureau newsletter should be your weapon of choice, and you can sign up using the link in the description below or the QR code currently displayed on your screen. Okay, right, with that, let's get back to it. Okay, our second case study is Zcash. ZEC is up over 50% in the last 30 days with a market cap of a little under $9 billion. And the reason this matters is that ZEC is doing this while almost every other so-called legacy alt is pretty much dead in the water. Litecoin, Bitcoin Cash, all of the 2017 era survivors are bleeding. So, what changed? Well, three things. First, the regulatory overhang lifted. The SEC recently closed its investigation into the Zcash Foundation with no enforcement action, removing a major institutional barrier that had suppressed price for years. Second, the supply dynamics tightened. Roughly 30% of all circulating ZEC supply is now locked in shielded privacy pools, the highest level in Zcash's history. The Orchard pool alone grew from 1.92 million to 4.55 million ZEC in 12 months. That is supply leaving exchanges and going into vaults. A supply sink not everyone is pricing in. And third, the privacy narrative completely reframed itself. For years, privacy coins were treated as a regulatory crime scene waiting to happen. The Tornado Cash prosecutions taught the market something very important, however. Privacy via smart contract mixer is a regulatory target. Privacy at the base layer, though, with optional viewing keys for compliance, is a completely different legal animal. That is what ZEC is. And Grayscale has now filed to convert its Zcash trust into a spot ZEC ETF. Cypherpunk Technologies, backed by Winklevoss Capital, had accumulated over 294,000 ZEC, approximately 1.8% of circulating supply, as of its most recent public disclosure in March 2026, and has stated a long-term goal of reaching 5% of total supply. Multicoin Capital's co-founder has called ZEC the cleanest public market expression of the privacy thesis. Arthur Hayes frames it as essential infrastructure for an AI-driven surveillance world. And with the November 2024 halving behind it, ZEC's annual inflation is now just 2%. Now, you might assume this is just another narrative pump that fades in a month. But that assumption ignores the on-chain data. The shielded pool has been growing steadily for over a year. Grayscale and Coinbase Custody are actively building the institutional plumbing. And most importantly, the SEC investigation was the biggest barrier holding Zcash back, and that threat is now completely gone. So, this rally is being driven largely by fundamentals and not just market vibes. Which brings us to the core of the barbell. Because as exciting as Hype and ZEC are, the anchor of any serious portfolio in this cycle still starts with Bitcoin. And the on-chain data here is very interesting. Bitcoin exchange reserves have collapsed to roughly 5.88% of supply, a 7-year low. Whale wallets holding 1,000 or more BTC accumulated approximately 270,000 coins in a single 30-day window, described as the largest such accumulation event since 2013. SpaceX recently disclosed that it holds 18,712 BTC and did not sell a single coin throughout 2025. Strategy accumulated approximately 89,600 BTC in Q1 2026 alone, per the company's May 2026 earnings disclosure. This is what real accumulation looks like, and it's happening underneath a price chart that looks like nothing is working. So, the barbell framework has Bitcoin as the monetary anchor, then 3 to 5 concentrated high-conviction satellites with revenue, regulatory clarity, and real fundamentals instead of 47 random Solana meme coins. Now, the truth is that the next bull market is not going to look like the last one, and most retail investors are going to miss it completely because they're still mentally calibrated to the spray and pray era. This market has institutionalized itself in slow motion over the last 2 years, and the institutionalization has been brutally consistent. ETFs concentrate flows into BTC. Revenue concentrates flows into a handful of cash-generating protocols. Meanwhile, the 10-year Treasury yield at 4.5% creates a hurdle that did not exist in 2021 when cash yielded effectively nothing. In 2021, the opportunity cost of holding a speculative bag was zero. Just about any random shitcoin could beat cash. In 2026, though, cash yields 4.5% risk-free via treasuries, which means an investor must expect meaningfully higher returns to justify any speculative exposure at all. This is the mechanism behind the flight to fundamentals, and this flight to fundamentals explains why hype is pumping while most altcoins bleed. It's the same reason ZEC is rallying while Litecoin stagnates, and why Bitcoin is seeing massive accumulation even with a boring price chart. Right, folks, a quick interlude because I think you're going to want to know this as well. Now, a lot of people still think Coinbase is just a beginner platform, but with Coinbase Advanced, that's actually changed quite a bit. You're getting lower fees, proper charting tools, real-time order books, and full control with limit and stop orders. So it all feels much closer to a professional trading setup, but without the usual complexity. So whether you're stepping up from basic apps or just want a cleaner, more reliable platform, it is definitely one to have on your radar. And if you want to try it out, there's currently a limited offer for Coin Bureau viewers. You can get $40 in Bitcoin when you trade $40. Now, this is available in the US, Canada, Europe, Singapore, and Australia, but it's capped to the first 350 people, so it may not last long. You can scan the QR code on screen now or check the link in the description and pinned comment for full details. And with that, let's get back to it. Ben Cowan has called the current phrase a junk coin purge and frames it as a necessary precursor to a sustainable bull cycle. Adam Back has gone further and said that efficient markets may eventually price most altcoins and meme coins near zero. That is the world we are now living in, and the asymmetry is hiding in plain sight. Infrastructure adoption is accelerating even as prices are depressed. Tokenized real-world assets on Ethereum just hit $8 billion, doubling in 6 months. Real-world stablecoin payments doubled to $400 billion in 2025. The underlying use case for crypto is stronger than it has ever been, but the market is so bored that almost no one is paying attention. That is the setup. So, first, restructure your portfolio around the barbell. Bitcoin as the core anchor, then 3 to 5 high-conviction satellites with revenue, actual users, and a defensible token sync mechanism. Holding 30 different bags doesn't give you diversification, it just dilutes your returns. If you get any returns at all, that is. Second, learn to read protocol revenue properly. Go to DeFi Llama, click the Fees tab, sort by revenue rather than gross fees, and divide annualized revenue by circulating market cap. That is your crypto price to sales ratio. It's the single most important screening metric in this market. Third, watch the unlock calendar. Use tokenunlocks.app to map every major vesting cliff over the next 12 months for any token you hold or are considering holding. If a project has 9-figure unlocks ahead and no revenue-funded buyback to absorb them, that is structural sell pressure you cannot fight. Fourth, monitor developer activity through Electric Capital reports and GitHub directly. Teams shipping during a bear market are the teams that deliver products in the next bull market. The 2018 to 2019 winter built Chainlink, Aave, Uniswap, and Synthetics. The 2022 to 2023 winter built Hyperliquid and Pendle. The next set of winners is being built right now in this exact lull by teams that almost no one is watching. Fifth, track the institutional signals. Filings, ETF applications, custody integrations, whale wallet movements through Nansen and Glassnode. These are the smart money fingerprints, and they're leaving their marks in plain sight while retail is too bored to read them. So, are you going to spend the next 6 months bored scrolling X waiting for someone to tell you what to buy when the next leg starts? Or are you going to use this quiet stretch to do the work, identify the 3 to 5 assets you have genuine conviction in, and accumulate them while everyone else is convinced this space is dead? Because the people who got rich in 2021 mostly got lucky. The people who get rich in the next bull market will be the ones who treated this lull as an opportunity to identify the few crypto projects that are actually worthwhile. Okay, thank you all for watching. Let us know your thoughts in the comments down below, and I'll see you again very soon. This is Guy, signing off.